All right, here we are. You remember how I said I rarely prepare or do some sort of procedure before I start my videos? Well, I had to do that this time because this price action has been horrendous. I could barely find examples for this episode, in which this is episode 47 of the ICT Mastery Mentorship. In this episode, we'll be going over market maker models. Okay. This is dealing with a concept you've learned previously in this chapter, which is power of three. Okay, so it is dealing with that. But it's a bit more, how can I explain this? Advanced. It's a little bit more advanced than just the casual accumulation, manipulation, distribution. This is dealing with that, but we're taking it just maybe 2 or 3 steps further, okay? But bro, when I tell you I had to spend I don't know, 30 minutes looking for examples, it really got annoying. But anyway, I tried to delineate them with just a singular line in which I only found 2 examples out of all of this. You're probably going to see other examples within this in which there's a reason I didn't pick them because it didn't deliver right, it didn't do the consolidation correctly, just stuff like that. So these are the best 2 examples that I can find, an ideal example of how it should look. But anyway, let's just get into market maker models. Market maker models, I just explained it. Simply power of three, but a more advanced version of it. If you want to get even more detailed, this version of power of three or market maker models include 3 stages: original consolidation, sell side delivery, and buy side delivery. Okay. The first stage of delivery, okay, based off if it's a bullish or bearish market maker model, that'll be your manipulation. Okay. So if it's a bearish market maker model, meaning the final stage of delivery is sell side delivery, you would have the original consolidation. Then you have buy side delivery as the manipulation to jump higher, to manipulate, in which you have the sell side delivery after it to distribute lower. Anyway, let's go ahead and start this because I delineated them from the consolidation itself. So in most recent price action this month, actually, well, not anymore because we're in February, but in the previous month, from when I'm recording this, January 2026, we formed a market maker model that entire month. Okay, we got the original consolidation here. We have the sell side delivery, then we have the buy side delivery. So this is a bullish market maker model which you're witnessing here or watching. The original consolidation would be, let's see, just this entire range here. Just that right there is the consolidation. I don't think I have to specify the consolidation. You see it. It's clear as day, right? So we're just going to mark this as original consolidation, like so. There we go. I said there you go, but I didn't even find it. You remember how I said that? My brain moves faster than my body. I swear. I said there we go, but the original consolidation wasn't even on the chart. Let's not even worry about it. Anyway, we have the original consolidation there. Okay. One important factor about the original consolidation, you cannot misinterpret it, or you will get ran over if you're using just market maker models by itself. If you're using it as a confluence, it might be all right to miss the original consolidation. And the reason I'm saying all right is because I really don't know. Because rarely, it's very rare for me to not know something. But for that right there, since I don't misinterpret it too much, I don't know if it's okay to misinterpret it if you're just using it as an influence. But if you're using it for entries, like on the 1 minute and 3 minute and 5 minute stuff like that, then you cannot misinterpret the original consolidation. If you're saying, I don't know, this, you see that? Bro, my brain moves faster than my body. If you're saying like this is the original consolidation for, I don't know, a bearish, not a bearish, but a bullish, what is it? Market maker model, then you misinterpreted. This is the original consolidation. There's a reason we have original in it because this is the original consolidation that starts the market maker model. So do not misinterpret that. Okay. If you want, after this video is over with, I suggest you go train this. Okay. And I forgot to be mentioning that for every episode, but after you're done with an episode, go train yourself on that concept for like a week or maybe a whole entire day, 12 hours if you're done with work, if you're done doing something, done with school. Train yourself in that concept, go back test it, and even go on FX replay and actually go trade it yourself and go back test it. Anyway, just don't misinterpret the original consolidation. After the original consolidation, since this is a market maker buy model or a bullish market maker model, the next stage of delivery would be sell side delivery. Okay. Within this sell side delivery here, you will have something that's called accumulation. Okay. That's all it is. It's called stages of accumulation. You will have 2 of them. Okay. The first 2 are what's the word? Are the highest probability. Okay. And the most profitable. Okay. So you have a first stage accumulation and second stage of accumulation during the first stage of delivery throughout the entire model. Okay. So since sell side delivery is the first stage of delivery, you would be having stages of accumulation within that, in which during the second stage, which would be buy side, because this is a market maker buy model, you would have stages of distribution. Okay. So remember how I taught you that price tends to accumulate positions? That's basically what's going on here. Within this sell side delivery here, this right here, or really starting from right here, but you get the point. This is really where it started delivering at. Within this run lower here, price will be accumulating longs. Okay. It'll be accumulating longs at bearish PD rates. You're probably like, what? Huh? Yeah. That's why the market maker buy model is so versatile. Because whenever you, I wish I could show you like an example of ICC saying it, because I think he'll explain it a little bit better than me. But let me see if I can show you an example here. So starting from here, let me mark it as sell side delivery so you'll remember. Right, if I can get it. Where's it at? I swear I have it. Oh, there it is. It was all the way at the bottom. Okay, sell side delivery, right? Price will be accumulating what? Longs here. It'll be accumulating longs during this sell side delivery so they can get distributed. Oh, I just mentioned stages of distribution within this run here. It'll tend to distribute it within that final stage of delivery, which is what? Buy side delivery. Okay, you're already putting the pieces together. We're doing it together. Here we have a mitigation block right here. Deepest down close candle as the actual swing low is the mitigation block. Breaks below it, activating it, retraces back up in that same candle, hitting the mitigation block. When it does that, smart money is accumulating what? Longs. Yes, that's exactly what's going on here. They are accumulating longs for this future buy side delivery here. At which, hold on, my bad. At which, when we get above that original consolidation, that's where majority, keyword, majority of the what is it? Majority of those positions will be distributed, okay? Because that's the primary target. The high of the original consolidation would be your primary target for the entire market maker buy model, okay? So that's your first target, but there is more targets. I'm going to show you that in just a minute. It's dealing with actually, did I show you that? Hold on, because I might need to check that. I don't think I taught you that yet. No, I actually have not taught you that. Wow. Okay, yeah, so I can't even teach you that yet. I have to wait until I actually get to that episode. So going back here, it retraces back up into that mitigation block. Smart money is accumulating longs, at which we begin dropping lower. Drop, 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 drop. Below that low, we accumulate more longs. We retrace up. Would we even call this a fair value? No, I don't even think we would. So it does retrace up into this, in which, you know what? It is a fair value gap. You know why? Because there's only sell side delivery here within that candle, at which in between there also there's no delivery at all. So it does just expand into that. I just gave you a little bit of extra knowledge, but it just clicked in my head just now because it makes sense. There's no delivery within that right there. If I can pull this over, no delivery here at all, in which there's no buy side delivery here either. So it just prints lower, if you get what I'm saying. So this entire thing is a fair value gap at which a portion of it is no delivery at all. So both sides have to be delivered here. So it does refer into that fair value gap in which smart money is accumulating more what? More longs. Yes, that's what's going on here. We jump up into the fair value gap, accumulate more longs, break below that low there to accumulate even more longs. Okay, we're buying below the lows. We're doing the sell side delivery, in which we drop down below these lows here to accumulate more longs. Again, we're buying below the lows. We're buying below the lows, and we're buying at the bearish. What's the word? We're buying at the bearish PD raise or the bearish opportunities that the algorithm is offering us. Okay, that is called hedging. Okay, we're not going to do that directly. Okay, but the larger portion of smart money, in which I taught you this before, you got Interbank, and then you have the smaller version of smart money, which is just called smart money, I guess. But the Interbank level, what they're doing in that first stage of delivery is they're hedging orders. Okay, this is where you'll really see us trading it directly. And when I mean directly, I mean we'll be trading it as intended. Also meaning, how can I explain this? We're buying the buy side delivery, okay, instead of us buying the sell side delivery. Okay, that's up to the big boys. The big boys will do that. So when the big boys, the interbank level, the institutional level, they'll be hedging this sell side delivery, okay, which causes this to have heightened volatility. This buy side delivery for us, the smaller smart money traders, this causes us to be like, oh, okay, there we go. Yeah, that's good. We're getting that volatility in. That's for us, in which we can still trade this. We can still trade this sell side delivery. I forgot to mention that because since the Interbank is hedging this run, we can still be selling it because we know that they're hedging it for the future buy side delivery. So for us, we'll be selling the sell side delivery, in which for the Interbank, they'll be buying sell side delivery. I just explained how. And then for us, we'll be buying the buy side delivery, or basically doing exactly as price tells us to do, in which the Interbank will be selling the buy side delivery. You know why? Because they have to get rid of all the longs that they accumulated here. So if you bought something, you have to sell it back to the market. So we're buying here, in which we have to sell it back to the market. And no, not us, but in which the interbank level has to sell it back to the market when price is going back higher, running above all those highs here, or the main point, the high of the original consolidation. That is where majority of where's buy side liquidity? Right there. That's where majority of the interbank hedging is distributed right there at that point. Once it breaks above it, it should not necessarily stop, but you probably won't see any more opportunities to what's the word? To take a trade any longer. Once it hits that original consolidation, you might just want to give it a minute to retrace or do whatever it needs to. But going back into the actual market maker buy model, because I went a little bit off topic, let's jump into the buy side delivery. So looking here, what price will do now, since we have accumulated longs here and price is ready to go up, okay, Interbank knows way more than we do, but we trade just like them. We understand the market just like we do, but their anticipatory skill development is way just way better than ours. Okay. They saw this move coming all the way during this consolidation. That buy side delivery here, they saw that within here. They saw that. That's why they started hedging longs within that sell side delivery there. There's a reason for everything. And I forgot one thing to mention here too. During sell side delivery, right, when we're manipulating, because that's what it's for manipulation, this sell side delivery has to refer to some sort of reference point. Has to the left side of the market, of course, because that's where all the reference points are going to be. What reference point did we refer to? What did we bounce off of? What PD rate did we hit? Just what? What did we hit? Well, we move over. You're probably like, oh, we hit that fair value gap there. Right. Well, it is a fair value gap if you want to consider it one, sure. But this is something else in which I don't think I've taught you yet. Let me mark this fair value gap. It is a different PD array in which it's kind of the same thing dealing with fair value gap, but it's different. Way different. But this is, in your knowledge, a fair value gap in which it does drop down into it, refer to it, respecting to what? Want to see? Do you want to see this? Yeah. Let's see real quick. Let's just see. Oh my God. Is that real, JJ? Yeah, I think that's real. I think this is real price action that's actually happening. Wow, look at that respect. And wow, I didn't even draw it properly. Hold on, let me adjust this real quick. There we go. Now we can really see it. Drops down, hits equilibrium, barely offers an institutional order flow entry drill. But you do see the respect that's going on here. So do we have the respect of a reference point or have we referred to a reference point? Because referred is still saying we respected that reference point. So did we refer to a reference point during the sell side delivery as manipulation? Yes, you did. So now that we officially manipulated and referred to something to reverse, we can now reverse, which is the buy side delivery, which starts down here. So I can mark that as buy side delivery. And here we go. So for both sides of delivery, I forgot to mention this, in which during the sell side delivery, it'll be stages of accumulation. And then during the buy side delivery for a market maker buy model, by the way, it'll be stages of distribution. Whenever price touches a reference point or refers to a reference point, that's one of those stages. Okay. So this mitigation block here, that's a stage of distribution because we're in the final stage of delivery, which is buy side delivery. We're distributing all the longs that were accumulated here. So when we touch this, boom, we got rid of some orders. That is the majority I was talking about. The majority of the orders are going to be coming off here, but they're going to be doing, how can I explain it? Micro closings here or micro distribution, if you want to call it that. Very small increments of just taking off orders slowly. But majority, 75% of the orders that they have accumulated will be taken off here. But they'll be taking small, intricate, not intricate, but, small, minuscule pieces of their orders off at these arrays, at which it refers down into the mitigation block right here. See that? Drops down, jumps back up. See that? Drop down. Interbank is like, okay, sell, I don't know, 300 million of the longs we accumulated yesterday, of the $1 billion longs we accumulated yesterday. Then it jumps back up again, hits a fair value gap, respects it, closes above it, in which they close more orders. Can we get a sell for 300 million? And then we'll sell the rest of the 2 billion up here above the original consolidation. That's in short, that's basically what's going on. That's literally what's happening. So we have both stages of distribution here. First stage being the mitigation block right here, in which I do think there was another stage. I think that would be like the order block. Yeah, that would be that right there. That would really be the first stage of distribution. You could say that, but that happened before we referenced that fair value gap there. So that would not be a stage of distribution, because we can't have a stage of distribution if we're not even in the buy side delivery, right? That just can't happen. It doesn't make any sense logically. So this, the mitigation block touch, would be the first stage of distribution. Boom. Remember, the first two stages are the most probable. I'm not going to introduce any other stages because, they're less probable and what's the word? They're less profitable. Probable and profitable, just, tongue twister. But the first two stages of distribution are the most profitable and probable, in which we touch it here, deliver away immediately. We touch it here, deliver away immediately. That's what I mean by probable. We need to see price, touch it, move away. Does it do it? Yeah. Touches it here, respects it, closes above it, and then we start to see that willingness of it going higher. We displace away, in which we touch that fair value gap here, drop it into it, we displace away. So the first two are normally, you're probably only going to see two. You could see more, but majority of the time you're only going to see two really, really good stages for both sides of delivery, in which we had one over here, which was the, let's see, the mitigation block, and then we had a second one right here, which was that fair value gap. So you see what I'm talking about? You're likely not going to see any more than three stages, in which the first two are the most, what is it? You say, I'm not going to say it. Exactly, most probable and or most profitable. You get it, you get it. So let's get rid of all of these drawings, and I guess we can have a little overview or review of the market maker buy model. Okay, so we understand that for the market maker buy model, we have the original consolidation. Next, we have the sell side delivery to manipulate. So translating to power of three, we have accumulation, manipulation, which the buy side delivery is kicking in, distribution, and in which during the stages of manipulation, this is manipulation here, we'll be having stages of accumulation within manipulation. Okay, we're just translating this over to power of three so you can get it just a little more. So the first stage of the market maker buy model is sell side delivery, which is manipulation. During that sell side delivery and or manipulation will be stages of what? Accumulation. Got it. In which the buy side delivery, translating over to power of three, is what? Distribution. In which during this distribution, price will do what? Have stages of distribution. It'll be distributing all the orders that they accumulated during this manipulation. Super, super simple. It's not hard, is it? No, it really isn't. I think I might do one more example. I think, hopefully I marked it as a market maker sell model. I really don't think I did, but I really, really hope I can find one, because there's barely any market maker sell models in this. Okay, I think I found one. Hopefully, let's pray to God I actually found one, because bro, I could, you know, the Nasdaq is just naturally gonna go up. It's an index, so it's gonna go up. So primarily you're gonna see bullish arrays, bullish confluences, bullish models, bullish signatures. That's all you're gonna see. So this is pretty rare, honestly. Anyway, let's, knock this right out the park. Let me drop to the 15-minute and mark this so I won't forget where it is. Let's pray to God that TradingView lets me even go this far. Uh-oh. Might not let me go this far. What is this? December 10th? Yep, December 10th. It might not let me go that far. Oh, it actually did. Okay, cool. That's that's good. TradingView normally doesn't let me do that. Anyway, we have the large original consolidation. The larger the consolidation, by the way, the stronger the market maker model will be. So we have a really huge original consolidation, gigantic. So let's mark this right here as, I'll mark it from on top right here. Mark that as the original consolidation right there. In which you might be like, oh, is this the sell side delivery? No, this is a market maker sell model. Hear me out. Hear me out. Before the first stage of delivery, price purges the low of the original consolidation. Price can do that. It can do that. It does not mean, keyword, it does not mean it is offering sell side delivery. It does not mean that. So just watch how price acts along those levels. So we can mark this as liquidity purge. There we go. Now look here. This is the buy side delivery. Okay. This is a market maker sell model now. So everything is just flipped over. Market maker sell model. Where is buy side delivery? There we go. Okay. Since buy side delivery starts here, what's going to start happening? We're going to start seeing stages of what? Stages of, you got it. Come on, just say it. There you go. Stages of accumulation. That's always going to happen during the first side of delivery, no matter what type of delivery it is. Since this is the first stage, it'll be first stage of accumulation. So we have this order block here. I think you see it already. These two deepest down close candles. We drag that out, in which price refers to it multiple times, but it never closes below the equilibrium. What does that mean? Respect. We're having respect of this. So our first stage of accumulation would be this order block, in which, like I said, the first two are pretty aggressive and pretty probable. Right after it hits that order block, it expands. But that's not the only reminder. That's not the only accumulation we have here. We have another one. Yes, another one. And I think it'll be this breaker, actually. Hold on. Is this a breaker? Or does it run through it? Please don't tell me it runs through it. No, it's such a nice little breaker. Well, no, it's really not, because the start of this entire move up to create this high was this low there, in which price would have to break the low, then come back up and break that high for it to be a breaker, in which it did not break that low. So that's not a breaker. That's instead a mitigation block. Draw it out right there. Boom. So second stage of accumulation. Pierces up above the high, activating the mitigation block. Next two candles drop down into the mitigation block. Look at that respect. Look at that. Bodies, bodies, bodies. Wicks do the damage, bodies tell the stories. The body closes right at the mitigation block, not below it, not even at it. Actually, it closes right above it. That's some beautiful respect there. It's really just loving these PD rays and treating them with such respect. Huh. Such a good pun, right? I need to stop. I got to stop doing that. It's so cringy. Anyway, it drops down into that mitigation block, second stage of accumulation, in which the first two are always what? Highest probable, or most probable, and most profitable. Price, as soon as it's time, it jumps through the roof. Within two 15-minute candles, delivering 201 points. So we have now offered manipulation, right? Because the first stage is manipulation. We have the consolidation or the accumulation in terms of power of three right here. This is that entire thing here, in which we have manipulation, which is the buy side delivery. Okay. Did we refer to something? Did we refer to something? Maybe. We got to see. Maybe we did. Maybe we didn't. Let's see if we did. Let's see if we did. Yeah, we did. This entire candle actually is the order block. Let's draw that out. You're probably like, aren't these two candles the order block? Because that's the deepest up close other than that one. Well, let me show you something. Let me show you. Hold on. Let me show you. You see how when price comes down and activates the order block below that candle's low, it proceeds to violate it on this candle. The whole order block got violated. Remember, since this is a bearish order block, okay, the violation of it will be the high of the order block, or the high of that candle there. The high of the order block, if it's a bearish order block, would be the violation of it, or when it's broken, or when price will just not use it no more, or when it just can't be used. That's basically what I'm saying here. So since it violated it, this is the deepest up close candle after that's been violated. You're probably like, what about this over here? What about that right there? Well, okay, since this is higher than that, this quote unquote order block is gone. It's not an order block then, because this is higher than it. Since this got violated, this takes over that one's role. And since this one's role took over this one's role as an order block, this order block was never an order block to begin with because this one already, took over that role, in which that role got stolen again after this candle violated its high. So this is the new official order block, in which when we draw that out, if I can actually do it, where's the order block at? Here we go. Once we draw that out, you will see our price referred to it. Hopefully it didn't break it. Oh, it did. How sad. That's actually pretty depressing. I did all that work for nothing. But you get the point. We didn't refer to this, in which during the manipulation, we can do two things: refer to something or purge liquidity. Did we at least purge liquidity? Of course we did. Of course, we at least purged buy side liquidity. We at least did that. So mark it as liquidity purge. And wow, we did not reach that one. How depressing is that? Well, did we? Hold on, let me see. We might have actually reached both of these. Oh, yeah, we did. We definitely did. Yep. So we got two liquidity purges, actually. Well, not really two, because these highs are binded together because they're relatively equal highs. But you get the point. We take out buy side liquidity in the form of the manipulation for the buy side delivery, in which next is what? The sell side delivery. Let's mark that. Boom, bam, bow, bang. There we go. Oh, didn't mean to draw that. Okay, here we go. Let's see. What would be the first stage of distribution during the distribution? Translating it to power of 3, obviously. So, we do have this gigantic order block here, but it didn't really refer to it until that candle there, in which even still, let's see, let me draw this out. Hold on. Starting from here, draw it out. Boom. Breaks the order block's low right there, activating it. It retraces back up into it. Barely, not even barely. It doesn't even hit the lower quadrant. That's a lot of respect going on there. There's a lot of reference going on here. So we jump up into it within what is that? 3 candles, and we have a lot of respect. Don't even touch the lower quadrant. Don't even touch the equilibrium. We don't even reach up into it. We just bounce, and then we're like, okay, are you ready to drop? Okay, let's go. We drop. So that is the first stage. Well, no, hold on, wait, I had a misinterpretation here. That's the second stage. My bad. This is the first stage. I didn't even see this. You guys might have spotted it before me, but this is really the first stage. I'm sorry on that. We have the mitigation block, retraces, well, no, drops down, activating it, retraces back up into it within these 2 candles here, in which drops lower aggressively, per usual, right? It's supposed to do that because it's the first 2. The second one would be the respect of this order block, as I just mentioned and misinterpreted as the first stage. That's my bad. That I can make mistakes sometimes. I'm human also. But we retrace up into the order block, drop down, drop down, drop down, drop down. That is the distribution. Isn't that just amazing? Isn't that just amazing? So during the buy side delivery, okay, also known as manipulation, if you want to translate it to power of 3, but I'm not going to do that too much from now on. But for the buy side delivery of this market maker sell model, the interbank is accumulating shorts. Okay, they're hedging shorts within this buy side delivery here, at which during the sell side delivery or the distribution, they are distributing all their shorts that they accumulated here. So they're buying, they're shorting here, they're shorting here, and they're buying back here. They're buying back all their positions or closing all their positions. That's what's going on here. When you place a sell order and you click close, or you click the close all at market button, or whatever, or just basically anything dealing with close position, you're buying back your sell position. That's what's happening here. If you want to look in the order book or look at your order history, that's what you're going to see. You're going to see, oh, we sold here, and now when we're in profit, we're closing our position. But what's going on behind the scenes is you are buying your position back to actually claim your profit. That's all that's happening here. So interbank is what? Accumulating shorts, in which during the distribution and or sell side delivery, they are distributing their shorts by longing or by simply distributing their positions and or closing it. So you get the point. Okay, this is the end. Wow, 30 minutes. I just looked over. Jesus Christ. Sorry, I did not mean to make that this long. I was talking for 30 minutes straight. I'm sorry. Yeah, I'll end this here. Anyway, I taught you the anatomy of market maker buy models. In short, I basically tell you how to intro off of them too, using the first and second stages of both sides of delivery, accumulation, and distribution. You can trade both stages of delivery, by the way. Of course, not on these time frames, but if you are that type of trader, that swing trader, or that what's the word? Just that longer term of a day trader, then yeah, you might be doing it on this time frame. But I'm sure majority of you, you're on the 1 minute, 30 second, 15 second, just like me. I'm teaching you my ways, so you're probably going to be. It's very very likely that you're going to be adapting my ways with just trading the 15 second, 1 minute, stuff like that. I don't go any higher than the 1 minute. I stay below that and below it. But anyway, I've been talking for 31 minutes, going on 32. I'll be in this episode here. I hope I taught you this well, and I'll see you in the next episode. Good luck and good trading.